The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. The Sure Investing Podcast is hosted by Nick McCullum and supported by Sure Dividend, an investment newsletter provider aimed at helping people invest better through low-cost, long-term positions in individual securities. All opinions expressed by Nick and podcast guests are solely their own opinions and do not necessarily reflect the opinions of Sure Dividend. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. For more information about Sure Dividend and the research our firm provides, go to www.suredividend.com/research. Today's conversation is with Tobias Carlisle, a professional investor and the author of The Acquirer's Multiple, Deep Value, Concentrated Investing, and Quantitative Value, which happens to be one of my favorite books on investing. Tobias is a co-founder and managing partner at Carbon Beach Asset Management, a value investing firm that manages portfolios for high net worth individuals, endowments, and institutions. My conversation with Tobias is wide-ranging and discusses everything from special situations investing to portfolio construction and the Kelly criterion to an interesting concept called the broken leg phenomenon. Please enjoy this wide-ranging discussion with Tobias Carlisle. I just wanted to start by thanking you for being on the show. I read some of your books and been following your work for a long time, so I'm really excited to chat with you. So, Toby, you've done a lot. You've wrote some books. You have, your own personal investment strategy you run that works on your books. You've been an M&A lawyer. So I thought it'd be helpful for our listeners to start by just recapping where it all started and what originally made you become interested in investing.
Thanks very much for having me. I first learned about value investing when I was at university in Australia. A friend of mine read Security Analysis and Warren Buffett's letters, and he said, "Do you know Warren Buffett is basically the greatest investor alive, and you can read all of his letters for free on the internet. And also, did you know that he runs an insurance company?" Which I found that really odd at the time, but I understand why he does it now. So I read all of his letters online, tried to sort of summarize them down. I got the Lawrence Cunningham book, which sort of gets all of his letters and puts the themes into the same place, so you can read the themes at the same time. And I read the original version of Security Analysis, the 1934 version, which is really, really hard to read. And, it's mostly about railroad bonds and very, very hard going. I graduated undergrad, I went to law school, and then I started working as an M&A attorney and a corporate advisory M&A. So it was when I first started, I was expecting to do a lot of IPOs, but what happened was the 2000 stock market crash. My first day was like April 2000, which was basically the very top of the dot-com boom. And so then I spent most of my time doing M&A because people just couldn't raise money anymore. And there was this curious kind of phenomenon occurring at the time. Didn't really have a name for it, but there were these small investors who would buy shareholdings in these dot-coms that had been absolutely crushed. And then they'd have like a 5% or a 10% shareholding. They'd lobby to get on the board, lobby to have it wound up, or they'd sort of try and get control, and then they'd use that to buy another one of these companies. And it was one of those things that I had kind of enough. I'd read enough value investing stuff, and I was aware that Warren Buffett was kind of a wonderful company at a fair price guy. And it was just difficult to see what these guys saw in these dot-coms that were, they had no business, or to the extent they had a business, it was just burning cash. But what they had identified, of course, was that they had raised lots of money and they were trading below their net cash value. And so they'd get control and they'd either buy out all the other shareholders and then have a company that had more cash in it than it cost them to buy it, or they'd use that company to sort of daisy chain others. So I went back to that 1934 edition of Security Analysis, and I found the chapter on liquidations and shareholder rights, and then I realized what they were doing. And so all those guys who started doing that stuff, they eventually became that phenomenon became activism. And so I sort of started right at the very start of that, and I worked with a lot of companies defending activists just because it was a bigger law firm and the companies tended to be bigger companies that an activist kind of grew up. So there was that boom from sort of 2000 to 2007, 8, when activism sort of they went from being kind of individual guys who had a little bit of money to kind of being a little bit more institutionalized and moving from pure balance sheet activism to operating activism, and they were trying to get them to fix the business. And so I was there as a lawyer, and I watched it all happen. I found it fascinating, and I thought if I ever get the opportunity to find stocks like this again, if the market ever crashes again and stocks trade below net current asset value, net cash value, then I'll do something about it. So the next time the stock market crashed was 2007 to 2009. I launched greenbacked.com, which was a little blog, just looked at classic sort of Graham nets where there was an activist involved who was trying to work the company out. And those stock picks all did really well over the few years that I ran the blog. In 2009, at the very end of 2009, I had a very good year. And I went back to look at the cohort of companies that I could have invested in. And, I'd sort of gone through and don't buy this one because it's burning too much cash. Don't buy this one because it doesn't have an activist involved. Don't buy this one for whatever other reason. And I looked at all of the ones that I could have bought and didn't buy. And I found that they did about 3 times better than I did over the course of the year. So I sort of started down this process of becoming a little bit more systematic, a little bit more quantitative. And that's the process that I've been following pretty consistently since sort of early 2010. So I call myself a deep value investor. So I'm not looking for that wonderful companies at a fair price thing that Warren Buffett looks for. I'm looking for fair companies at a wonderful price, and I'm trying to do it in a pretty systematic way, so to eliminate behavioral biases and things like that. And that's so I run that strategy in managed accounts and a private fund, and we'll be launching a public fund in the not too distant future.
So this is interesting because you've done a lot. You've blogged at Greenback, you've published a few books, you've doing your stuff at Carbon Beach Asset Management, and now the Acquirers Multiple. So at what point did you decide that you wanted to take more of a long-form approach and publish your findings in books instead of through your blog at Greenback?
At the end of, as I was sort of going through that process, shifting from being a deep value net type investor to being a little bit more systematic, I was hunting for a book that sort of explained that process. I'd never really heard of quantitative value investing. I now know that there is quite a lot of literature around it. It has existed as an idea for a really long period of time, but I just couldn't find it at the time. The only book that I was aware of, which is an excellent book by Jim O'Shaughnessy, What Works on Wall Street, but I had only ever used it as sort of an encyclopedia or to look up like which strategies do best. And at the time, the version of the What Works on Wall Street that I had hadn't discussed enterprise value on EBITDA or enterprise value on operating income, which I was aware from the early 2000s when I looked at a lot of research that had come out about the activists as being a very powerful metric for finding stocks that were undervalued that were going to perform. And it's the metric that activists like to use because they imagine that they can go in and do something with the balance sheet. So they're looking at, what kind of operating income are we going to get? And it's also a metric that private equity firms like to use because they know that they can take the company over in its entirety and manipulate the balance sheet or, put some more debt in there. For the most part, that's what they're seeking to do. But I couldn't find any book that discussed that metric, and I couldn't find anything that sort of discussed quantitative value more broadly. So I had collected all of this research and I wrote on Greenback that I was thinking about writing a book, with no real idea about how you get a book published or anything like that. And I got contacted by Wes Gray, who he was a PhD student at Booth, and he said, I have access to this backtesting database at Booth. I was thinking about doing something similar, but I don't want to write it. So I wrote the book. Wes did the back testing, and the result was quantitative value. And Wes also said I have a contact and we can get it published with Wiley, which is sort of the biggest and the best in that finance investing publishing area. So that was sort of how it came about. And then the result was quantitative value, which which came out in late 2012. In the course of writing that Quantitative Value book, I was aware that Joel Greenblatt's magic formula, which everybody knows, that's where he takes the Buffett idea of wonderful companies at a fair price, and then he breaks that down into its constituent parts the way that Buffett describes that you should do that, which is to look for a very high return on invested capital as evidence of being a wonderful company, and that's how much money it makes for each dollar invested in it. And then on the other hand, to look for a high earnings yield, and the way he defines earnings yield is EBIT operating income, which is the way Buffett does it, on enterprise value, which makes sense because you get credit for the cash that the company has, and you penalize it for debt that it carries. And when he combined those two factors together, he called it the magic formula, and he back tested it, and he found that it outperformed the market pretty significantly. So that came out in 2006. We tested that idea. Greenblatt had only had access to, I can't remember exactly now, but a shorter period of data. It had sort of only run from 1990 to sort of 2006 from off the top of my head from recollection. And the database that Wes had access to ran from 1963 to 2010 or 11 at the time that we were writing the book. So we took that strategy and we subjected it to another liquidity and market capitalization constraints. So, is this just a phenomenon of small capitalization stocks, or is this something that would work in big cap companies? And we found that even with those constraints on it, that it had to invest in big companies, it had to do it by market capitalization weighting, had liquidity constraints, it still beat the market, which is kind of extraordinary. In the process of doing that, though, we devolved the two factors to see which one was responsible for the returns, or what each one contributed, and we found that the return on invested capital actually reduced the returns, and the value factor, which was the operating income, EBIT operating income on enterprise value, was responsible for more performance, was responsible for like 130% of the performance of the magic formula, which is interesting because James Montier, pretty well-known market strategist, he was at Dresdner Kleinwort at the time. He had written this little note. He called it the little note that beat the market about the book, where he had tested that idea in several different markets, and he'd found the same thing, basically that the quality factor, the return on invested capital factor, reduced returns, and it didn't help you in a risk-adjusted sense. The only thing that could be said for it was that it helped you in a market that was sort of very bubbly, like a late 1990s type market. So I thought that was kind of an interesting thing, and that was the focus of my second book, Deep Value, that came out in 2014. And the idea was, what is the reason for return on invested capital reducing returns, and how is it that these fair companies at wonderful prices seem to do better than, in a quantitative sense, how is it that they do better than wonderful companies at fair prices? And so I found the reason was there's a lot of mean reversion in return on invested capital. It's a very mean reverting series, which means that when companies are doing very well, other competitors come in from adjacent industries, VC might come in, and they tend to pull down the profitability of companies in those industries. And the reverse happens as well. If an industry is not doing very well, so for example, a recent example is when the oil price crashed, oil field services companies do really badly. All of the capital sort of gets sucked out of the industry, and only a handful survive. So competitors leave or they fold, and the ones that survive, then when the oil price picks up again, they start doing very, very well because there's no competition. They can charge premium prices, and that goes on in lots of different industries. So, and that mean reversion is the same thing that drives the returns to value. So undervalued companies, fundamental investors, PE, private equity investors, value investors come in and they find these undervalued companies and they push the price up until it gets to sort of the average valuation or beyond. And it happens on the other side too. When they get expensive, fundamental investors tend to come in and they either short or they don't invest in them. So those two phenomena are going on in the market all the time. Profitability is sort of mean reverting to the average, and valuations are sort of mean reverting to the average. And so if you're buying the wonderful company at a fair price, absent the sustainable competitive advantage, then you find that you slightly underperform simply buying something that's really undervalued. So that was deep value. And then I summarized them all in a more recent book called The Acquirer's Multiple, which came out in the last 6 months. And it just sort of, in very simple terms, explains that phenomenon, explains how to find stocks that sort of outperform in a quantitative sense, and explains why it's so difficult to find sustainable competitive advantages.
So that brings us to your last book, which is, I would say, noticeably different than your others in the sense that it's shorter and easier to read and more affordable. So it's centered on this concept of the acquirer's multiple, which is enterprise value on EBIT. Can you give some insight into why you made the change to a shorter and cheaper book, and I guess what the acquirer's multiple is and what the findings were with relation to that valuation metric?
The books that I had written for Wiley Finance, they tended to be sort of quasi-academic, lots of research and lots of charts and things like that were a little bit hard to read. And Wiley Finance tends to set a very high price point for them. I think they sell for sort of $85. And so those two criticisms that I had from people, I thought the idea was simple and powerful, but not a lot of people had read it for those two reasons. It was just too hard to read. It was too expensive to buy. So I wrote a simpler, cheaper book. So Acquirer's Multiple, it's like $9.99 on Kindle in Amazon. And I also went through it and I wrote it. I discovered this. There's a way of quantitatively examining how difficult your writing is to read, and I applied that to the book. So Deep Value was written at a grade 14 level, and so basically what it does is it equates your writing level to a grade in school. And so grade 14 is way too high. That's sort of equivalent of like second year college, second year undergrad. And it means that it won't be as read as widely as something that is written to a lower grade. And if you look at the most successful books, they're all written to about the 5th grade level. That's like an Ernest Hemingway, Harry Potter, Dan Brown, because they're easy to read. So I wrote The Acquirer's Multiple purposefully to an 8th grade level. It was extremely hard to write it to that level because my instinct is always to try and find an interesting word, and if you put an interesting word, they tend to have more syllables, which is one of the metrics. So the book is written to a very simple 8th grade level, so most people should be able to understand it, and it sells a little bit more cheaply. And the idea is so I can get this message out there because Buffett has been in the value investing community. Buffett's been so successful that most people assume that the best way of value investing is to follow his example, which is to buy that wonderful company at a fair price. But Buffett himself didn't adopt that strategy until he was quite advanced in his career. He was running the equivalent of sort of $200 million before he started doing that. And the reason that he changed was, of course, he had this interaction with Charlie Munger, who had some bad experiences with businesses. He had a harvester dealership in Bakersfield where you had to buy the harvester, which is an expensive piece of machinery, and it sat on the lot sort of depreciating until somebody came along and bought that harvester. And so he hated businesses and in order to grow, they had to buy more harvesters. So he hated these businesses where you had to put a lot of money into it up front, and then you were relying on your ability to sort of turn the capital in order to make any money out of it. So he was thinking about what would be the reverse of that. It would be a company that would grow a business that would grow really easily without requiring a lot of investment. That would be something that had a high return on invested capital, which would allow you to compound. But the wrinkle to that is the thing that I mentioned before, the mean reversion. So the only way to protect that is to have some sort of sustainable competitive advantage. So Buffett's great skill has been identifying those businesses that do in fact have a sustainable competitive advantage, which allows them to charge prices that give them more margin and more return on invested capital than they would otherwise be able to do. Many people have sort of tried to scientifically analyze how you go about finding these sustainable competitive advantages. And one is Michael Mauboussin. He has this ongoing research where he looks at in a universe of stocks, say the largest 1,000, and then he divides them into these 5 buckets. And in each bucket, so the one bucket is the highest return on invested capital. The second bucket is the second highest return on capital, down to the bottom bucket, which is the lowest return on invested capital, which tends to be companies that lose money. And then he follows those cohorts over 10 years to see what happens. And in each bucket, they tend to regress towards the mean. So the highest return on invested capital tends to trend towards the mean, and lowest return on invested capital also tends to trend towards the mean. So that means that the ones that are losing money start making a little bit of money. The ones that are making lots of money make less money. Hidden in that data, though, there are a small number of companies, and I think it's sort of about 4% that do, 4% of the 1,000, so that's about 40 companies that manage to resist mean reversion. So Mauboussin focuses on those, and he says, what are the characteristics of a company that can resist mean reversion? He uses a DuPont analysis. Basically, that looks at the way that a company generates its profit, and he says there are 2 possibilities for the way that a company can do that. It can sell high margin goods at a low turnover, so it's sort of profit by turnover, or it can sell lower margin goods at a very high turnover. And he says that the ones that resist mean reversion tend to be higher margin at a lower turnover. But then when he dives into those companies, he couldn't really find any characteristic that will allow you to predict over the next 10 years which of them will be the ones that will sustain that. All he could say for the cohort that I looked at in the book was that they tended to be biotechnology was one group, and the other group slightly escapes me at the moment. But he said basically it's very, very difficult to predict which of these companies will do that. And so Buffett's great skill has been to actually identify those companies in a pretty consistent manner. And if you read his letters with that in mind, you realize that he devotes most of his time in his letters to identifying that moat. I think for most investors, that's an incredibly difficult thing to do, to identify the moat. And for most investors, they'll be able to get better returns, kind of ignoring the quality of the business and just looking for deep undervaluation.
A large component of the research you've done so far is how to identify undervalued stocks. Another component of investing, though, is portfolio construction and portfolio management, which was the topic of concentrated investing. So can you provide some insight as to what your findings were in that book, and more generally, how you think about portfolio construction today?
Yeah, that's a great question. So when you start managing your own portfolio, you quickly realize that picking undervalued stocks is about half the battle, and the other half of the battle is managing the portfolio. You always want to put more money in the ideas that worked and less money in the ideas that didn't work. Unfortunately, you don't get a retrospectoscope to go back and do that. But I was interested in the different methods of constructing portfolios and what that meant for performance. So with Michael van der Beemer, who runs a big fund of funds in New York, and Alan Bonello, who's a value investor in San Francisco, they interviewed value investors who had a 25-plus year track record of outperformance, and then looked at how they had generated that track record of outperformance. And one of the things that united them was that they tended to run pretty concentrated portfolios. So in this context, concentrated portfolio means about 10 holdings. There's a great story about one of the investors in the book. A new analyst was working for him and walked into his office, and he said, what's the secret to this outperformance? And the guy said, tennis shoes. And he walked back outside and he thought tennis shoes, and he kept on thinking tennis shoes, what does that mean? And so he went and asked his head of research, what does tennis shoes mean? And the guy said 10 issues, 10 stocks. That's the secret. I only follow 10 stocks. So we looked at, there are different ways of portfolio constructing. There's basically an academic method, and that looks at volatility, variance, covariance of the portfolio. Basically what they're trying to do is, the context of that research was, how few stocks can we buy to get performance that looks like the market average? If we just randomly select stocks, how few can we buy to get to minimize the non-systematic risk, which is the risk that you don't track the market, which if you're an efficient markets person, then that's the biggest risk. There's systematic risk, which is that the market falls over, but you can't escape that. The only thing that you can avoid is non-systematic risk, which is not tracking the index. So that was the focus of their research, because they were in a time when it was expensive to buy shares. They didn't want to have to go and buy 500 shares, because that's an expensive thing to do. You need a really big portfolio. How few shares could you buy? And what they found was that at about 30 shares, you've eliminated all of the non-systematic risk. At 25, you're at about sort of 98% of non-systematic risk. And then beyond that, you're buying additional shares, and the cost of buying them starts outweighing the diminution in non-systematic risk. For most investors, that's not a very helpful idea, because that's not what they're trying to do. What they're trying to do is beat the market or be sufficiently diversified. So if any single stock blows up, goes to zero, the portfolio is not hurt too badly. So the way that value investors approach the problem is to say, let's define risk not as volatility, which leads to variance, covariance, efficient market hypothesis thinking. Let's define it as the risk of permanent loss of capital, which is, if that capital is gone, it can't compound anymore. And the smartest thinker in the area is, of course, Warren Buffett. And so he sort of popularized the idea of Kelly investing. So the Kelly criterion was developed at Bell Labs by John Kelly, who was a mathematician. He was doing it in the context of he was working for Claude Shannon, who was an information theorist. He identified the on-off 1-0 binary that is sort of the basis for all computing. And so he looked at, he had this idea for, if you have a noisy wire where you're transmitting information down a noisy wire, if you're losing information on that wire, and then you're trying to maximize your rate of return. So that's a little bit confusing. So he said, if you're aware of the outcome of a game of baseball before the game is finished, and you can bet on the game of baseball, how much would you bet knowing the result? You're 100% certain. You'd probably bet your entire bankroll, because you're 100% certain that your outcome is going to be the one that comes up. Now you have a noisy wire, so you might get the wrong message. You might not get any message. How much, therefore, should you bet? And so he developed this theory, which is how much should you bet to maximize your rate of return over assuming that you can keep on playing this game over and over again until you quit. So he developed the Kelly criterion, which is edge over odds. So edge is the correct odds of the outcome of this event, and odds is the odds that the bookmaker or the market or whoever else offers you. And so if you have those two pieces of information, you can figure out how much of your bankroll to bet, with the idea that you're going to maximize your long run rate of return. And so the idea of the Kelly criterion, it never risks blowing up. So it never invests 100% of the bankroll, or in most scenarios, it won't allow you to invest that much. If you're offered a bet that's a coin flip, it won't let you take a coin flip. It wants you to have a positive expectation bet, which is like 0.51% probability of winning. And then if you put that into so a 0.51% probability of a 0.51 probability of winning in an even game. So you put up $100, you get $100 back. It would tell you to invest 2% of your bankroll in something like that. And so that's basically dividing the 0.51 by zero point 0.5. And you find as the odds improve or the payout improves, then it'll tell you to bet more and more. Monish Pabrai wrote a book, The Dando Investor, where he took Buffett's idea and he actually explained how to do it using this, assuming in a stock market context where he says, assume a 0.5% chance of doubling, a 0.3% chance of going up 10 times, a 0.2% chance of going to zero. How do you then figure out how much to invest in this particular stock? And he was talking about a funeral home, Stewart Enterprises. He said that he invested 10% in the stock, but if he'd known about the Kelly criterion at the time, it would have told him to invest 97.5% of the stock. It became very fashionable to be a Kelly criterion investor in value investing circles. And the gentleman who popularized the Kelly criterion outside of value investing is Edward Thorpe. Edward Thorpe, who was a professor of mathematics at University of California, Irvine, still lives in Pasadena, ran a series of hedge funds, he first used it as a blackjack player, wrote Beat the Dealer, then used it as a stock market investor, wrote Beat the Market. And both books have been very successful, and both of his hedge funds have been very successful. His son, who lives in Pasadena, went along to one of the value investing congress that used to be held in Pasadena, and he heard that everybody was talking about the Kelly criterion, and he went back to his dad and he said, everybody's using this idea that you kind of popularized in an investing context. And Thorpe, who's still a mathematician, he wrote this mathematical proof where he took the Kelly criterion and he said, while Monish Pabrai's application of it is theoretically, technically correct, there are a variety of reasons why you wouldn't want to put 97.5% of your portfolio into Stewart Enterprises. And he went through those. And the first one was just, it's hard to get that kind of it's hard to get the precision that Kelly requires when you're investing in stocks, because it's simply not that simple. There's always more considerations to make. The other one, his second argument was that it ignores the possibility of black swans, which are high impact events that don't sort of have sufficient probability for you to factor them into your calculation. And he also said you should regard the Kelly criterion as the outer limit of how much you should invest, and anything that is sort of a fraction of Kelly is a legitimate bet to be making. So he often talks about, he's written a number of papers, and you can find in those papers he'll talk about going to the racetrack and making a fractional Kelly bet on some horse that he calculates to have the right odds. And that could mean the change in your pocket, that doesn't really mean anything. But if you take that idea, and so you take this sort of Kelly or half Kelly is sort of a popular fractional Kelly that people apply. So you calculate the Kelly bet for a position, you apply half Kelly, and then you make one final adjustment. And so it's possible that when you're running a portfolio, you have two Kelly positions that are more than 50%, or three that are more than 33%, four that are more than 0.25%. Kelly itself would never risk ruin. So Kelly would never tell you to bet your entire bankroll or more than your bankroll in stocks. So you need to scale those down, and you need to consider other positive. If you start doing that, you need to consider other positive expectation bets. So that could be a bank account that yields a return is a positive expectation bet. A bond that pays a coupon is a positive expectation bet. So treasuries are a positive expectation bet. You should be allocating some small portion to each of those things. If you include all of those things, that necessarily shrinks down your biggest bets. So after sort of going through all the mathematics of that, I realized a few things. One of them is that if you apply the idea of trying to match an index, you come out with about 30 names. That's also something that if if you look at what Klarman, Graham, lots of other value investors, they've fallen out at about 30 names. And if you test that, that kind of works pretty well. So it's one of those odd occasions where I think it's just random chance. It's somewhere between 20 and 30 names. The academics and the value investors agree, equal weight at inception. If you want to be a little bit more adventurous, you want to spend some more time researching the stocks, and Kelly is a great way of doing that, with the proviso that you have to adjust Kelly for stock investing the way that I described, and you have to be prepared to have some more volatility in the portfolio, because that is the result of this sort of higher rate of return, is a great deal of volatility. So I think when you in a practical rule of thumb sense, that sort of means that you really shouldn't ever size a position much more than 10%. 10 is about where Kelly falls out. And then you're well advised to have some other positions that are smaller than that. And you could have as many as 20 positions that include some sort of smaller 1% or 2% positions that might be a low chance of success but a very high payout if they work. And a 10% position might be a very high chance of success and a pretty good payoff. So you've got both of those together. So that's concentrated investing. It describes the theory of it, and then it takes you through, I think, 8 or so investors some of whom have thought that way, others of whom have just applied that 10 by 10 idea, which roughly matches Kelly too.
Is the reason why you need to make the adjustment to the Kelly criterion, does it have to do with the bets being in tandem or in parallel rather than being in series like they would be when you're betting?
That's exactly right. So if you're playing blackjack, you get one hand at a time, and you're able to adjust your bankroll for that hand. When you're constructing a portfolio, you're doing it in parallel. All of the bets are occurring at the same time, and so you have to adjust each bet for the other bets.
That's interesting. Now, the topic of portfolio management is a nice segue into what I wanted to spend the second half of our conversation talking about, which is your separate investment strategy that is a little bit more qualitative and focuses more on special situations and options trading. So give us a little introduction to that, and then we can dive into some more detailed questions.
Well, there are two. We run a special situation strategy that is a traditional special situation strategy, similar sort of approach to sort of Buffett partnership or Graham, where we're looking for true arbitrages. So that can be, we find them in a variety of different places, but the classic is risk arbitrage, which is the takeover. You find a company taking over another company, and you look at, in the traditional arbitrage, you sell the acquirer and you buy the company being acquired, you buy the target, and there's a little arbitrage between the bid price and where the company tends to trade in the market, because there's always some risk that it doesn't go through. There's a time value of money question. We don't do the traditional kind where that's sort of more akin to picking up pennies in front of a steamroller, although it has worked really well. I think Buffett says he got about 20% compound out of the capital that he put into it, or 20% each year that he did it. I haven't seen any further studies on it, but I understand that he's still returning something like that. We don't do that. We look for busted arbitrage, busted mergers, busted arbitrage. So there's still a bid there. You think the company's really undervalued. There's some hiccup in the fortunes or in the course of the merger, so the spread gets very, very wide. So that's got two good things about it. If you think the company's undervalued, then as a value investor, that's a good position to be in. And then you've also got the possibility that the arbitrage does in fact occur. Sorry, the merger does in fact occur. So that's been a happy hunting ground for us over the last few years. We also look at companies that are just undervalued. But then we might try and find a way to get a catalyst or get a return in them by using options. And there are two simple option strategies. One is selling a put, which gives you a risk profile that has the downside of equity, and it has a capped upside, but you get the premium up front. And so you might look at a $10 stock You might be able to find a $2 premium option with it, and it's a put that you're selling. So you're giving the other person the right to buy the stock at $8. So if it falls through $8, then you're losing money on that portion of it, but you've still got the premium that you received up front. So you can calculate basically the way that the calculation is done. If you know that the strike is $8, you're getting $2 in premium, then your implied buy price is $6. And in a $10 stock, that's a lot of the stock has to fall a long way for you to lose money in that transaction. And your return is $2 on $6, so it's about 33%. And then you would annualize that return. So that's put selling. Often people think that that's a very dangerous thing to do, but if you're an equity investor and you're used to equity downside risk, then it's just a matter of sizing it appropriately. So you might size it so that the notional matches whatever you would ordinarily put into a portfolio. The other one is leap buying. So it's sort of an entirely different way. It's the exact opposite of that transaction I just described. It's buying a call, which gives you the right to buy the stock at some time in the future. The thing that makes it a leap is you're buying a very long dated call. So it would be, we're in 2018 now. It might be the strike in January 2020, which I think for most stocks is about as far out as you can go. And in that instance, you're looking for not a lot of volatility in the stock, so a cheap option relative to what you're paying for, what you'd have to pay for the underlying stock. And the stock is undervalued at the same time. And you find that if the underlying stock performs well over the next 18 months or 2 years, the option will go up multiple times. But it's a way of sort of quarterizing your downside risk too. So a $10 stock might have a $1 call that you can exercise out 18 months or 2 years. So the way that you would think about that is now you have to pay basically $11 for this stock. So if the stock goes above $11, you'll do very well. And your $1, if the stock gets to $15, your $1 premium option might be worth $4 or $5. But it's a good way of limiting your downside risk. If that $10 stock goes to zero, you're only out the option premium that you paid. So we shape those ideas depending on how we feel about the stock, what the volatility in the options looks like. And that's just a way of sort of creating a catalyst where one might not otherwise exist. So there's an end date for the option. That means that you're getting paid one way or not getting paid, as the case may be. We also do things like off-the-run securities. So a Bank of America TARP warrant was one that we bought in 2016. So basically, when it looked like the world was ending in a financial sense in the 2008-9 bust, there were bailout securities issued, and one of them were these TARP warrants, and they're very long dated. A warrant is just an option convertible into stock of the company rather than forcing another investor to sell you the stock. The company must issue the stock. These things we thought that Bank of America was very cheap in the start of 2016. We thought the warrants were cheap relative to the equity. There wasn't a lot of volatility in the stock, and we bought them. And they have an end date of about 2021. So you have a very long period of time to run, limited downside, very undervalued stock. And the stock has performed pretty well since then, and the options have performed really, really well since then. So that's the idea, looking for off-the-run stuff, looking for catalysts, looking for unusual ways of generating returns by creating our own catalysts. So that's a special situations portfolio. I also run a much, much simpler strategy, which is just a sort of systematic deep value type strategy, which is long short. So it looks for what do I think, what does this thing that I've created think are the 30 cheapest stocks in the US, and what does it think are the 30 best short candidates? So that the long candidates are pretty simple there. I use the acquirer's multiple primarily, which is operating income on enterprise value. That's the same way that, as I said before, activists and private equity firms use to value companies. And I use some other metrics in there as well. Don't want things that have got financial distress. Don't want things that have got earnings manipulation, which is often a gateway to fraud. And so we look for fraud measures as well. Those are sort of statistical applications. Altman or Piotrowski, which are just statistical ways of identifying financial strength and other things like that. And then we look at the level of short interest in the stock. So heavily shorted stocks, they might not be a great short because you have to pay a lot for the borrow, but they're often not a very good long. So they're good stocks to avoid. It's one of those things that people often think that a heavily shorted stock is a potential squeeze candidate. So if they buy them, there'll be this pop at some stage in the future when the shorts have to cover. But the research seems to say that they're just not good candidates to buy long because the shorts are often very well informed. Short money tends to be smart money. So we just avoid them. And we look across every industry, every sector, and we find that we do a few other things in there as well, but basically that deep value portfolio, which doesn't look at return on invested capital the way the magic formula does. It just sort of it approaches these stocks the way a private equity firm or an activist might approach them. That does pretty well. You can get sort of an interesting return profile if you then look for some shorts in there as well. So shorting is a kind of a dark art. It's not the opposite. You don't reverse the process for buying something long to find something short. Something that is really overvalued and fundamentally weak might still be a really bad short if it's got lots of momentum in it. So you can find lots of these stocks. They're the story stocks. They're the ones that everybody knows about. Tesla, Netflix, possibly Amazon, other companies like that. That if Amazon is an exception to this because Amazon does have some incredible financial strength, but Tesla in particular is a fundamentally weak business. And the reason I say it's fundamentally weak is if you look at, they've been burning more and more cash each quarter in order to build these cars. The problem, though, for short investors who've been trying to short Tesla is that it has had this enormous momentum in it. So if you've been short, it's been an incredibly painful ride. So you can't just apply you can't reverse the process that you would use as a long investor to find shorts. You need to find some other things in there as well. And the other thing that you use, naturally, it's just what I've just described, is momentum. You want to find stocks that don't have any momentum. So momentum, as it's defined academically and by industry participants, is stock price performance, total stock price performance. It's a factor that has worked very well for a very long period of time. It has better return characteristics than value. Basically, the idea is that you look at the companies that have gone up the most over a given period of time, 3 months, 6 months, 12 months, and the ones that have gone up in the sort of the least volatile fashion, so they've just sort of smoothly rolled up over that period of time. They tend to be the stocks that do the best over the next 12 months or 6 months or 3 months or whatever the case may be. You can use that as an idea when you're trying to find shorts. So you don't want to find companies that have a lot of this momentum, because even though they're fundamentally weak and they're very overvalued, they're still going up and they tend to still keep going up. So you look for companies that have no price momentum or negative price momentum and also weak financials, very, very overvalued, lots of debt, deteriorating financials, in some financial distress. All of those things together tend to be very good short candidates. So the portfolio holds longs that are basically acquire as multiple longs, and shorts that are the reverse, but with the additional lack of momentum in them.
Okay, so I have about a dozen questions to follow up from that, but we'll start by just digging into this idea of merger arb and busted mergers. So would you say that, for example, AT&T Time Warner, is that an example of this strategy at the moment?
I haven't followed that one as closely. The best example I can give is the Aetna Humana transaction that started in 2016, and that's one that we were invested in. I followed it very, very closely, and we did a lot of things in there that sort of illustrate the way that we would go about doing that. So you might remember at the beginning of 2016, the Department of Treasury, which was Barack Obama's admin, the Department of Treasury wanted to stop the reverse mergers that were being undertaken for the purpose of getting the head office outside the US as a tax minimization strategy. So they blocked, the name of the transaction just escapes me right now, but they blocked I think it was Allegan. I can't remember now, but they blocked Allegan, and spreads in every single merger arb blew out in sympathy, and that might have been because the merger arbs had to unwind that particular transaction, and so they had to get cash from other places. Or it might just be that the fear that the Treasury might block other transactions sort of became real. So we went through all of these busted arbs. The spreads got very, very wide. On an annualized basis, some of the returns were very, very high, and we found the ones that weren't merging for the purpose of moving the head office overseas. And the most obvious one was Humana and Aetna. So Aetna, the health insurers in the States, Aetna's buying Humana. We looked at the gap between the offer and where it was trading in the market. It was about 30%, with the transaction set to close about 9 months later, which annualizes out to more than 40%. I think, I can't remember now, but 42, 45% annualized return, which is very, very good. And in addition to that, we thought that Humana was very undervalued. So Humana had been one of my longs in my systematic value strategy for a very, very long period of time, for 6 or 7 years. And I had held it all the way up to the bid, which occurred in July 2015, sold out at that time, and then ignored it for the next 9 months until it sort of popped up in the merger arb screen as being very undervalued. So we put that position on. The market sort of quickly recovered from that shock of the Department of Treasury blocking that transaction. And within sort of 3 months, the gap had closed sort of 5%. And at that stage, it was sort of, now you're in a risky merger arb that might not go ahead. The upside is less. So we took a lot of the position off, but we left a little bit of the position on because it was still positive expectation, still pretty good returns. The DOJ, which is a different, not the Department of Treasury, Department of Justice, came in and they blocked the transaction on the basis of antitrust. So Aetna and Humana combined were going to be about the second or third biggest health insurer in the States. United would be the biggest, and there were 2 others that were merging at the same time, and they would have been the second biggest. If that transaction doesn't go through, then Aetna Humana becomes the second biggest. We thought, being second or third biggest behind United probably means that this is still likely to go through, but the spread widened up a great deal. So we put the position on and it became our biggest position again. There was some question about whether the DOJ would actually file or what they would do. As it happens, they ended up filing and blocking the merger. Funny thing, on the day that they blocked the merger, the stock Humana jumped 15%, which is probably just one of those things that the thing that the market was most scared about was uncertainty, and the very worst outcome possible actually made the stock rally. So just knowing the worst outcome possible caused the stock to rally, which is one of the crazy things about the market. Humana came out immediately and said, well, we're going to sue, or Aetna and Humana came out jointly and said, we're going to sue for this merger to go through. The court date was set for December, and in about August or September, we knew that there were then going to be several months before anything happened, but there was a great deal of volatility in the stock. So we took that opportunity to sell puts, which gives you the downside risk of equity, but you get all the premium up front, knowing that most likely all of these puts were going to expire before they even got to court. And if they settled before they got to court, then there'd likely be a pop or something in the stock. So we thought that was a pretty good risk-reward return. So we got some option premium in while we were continuing to hold the stock. They went to court. They were ultimately defeated, and the merger didn't go through. So over the course of the 18 months to 20 months that Humana and Aetna had been trying to merge. United, which is another company in the sector, had gone up a great deal, and Humana had sort of been stuck where the bid price was, and probably on a peer comp basis, it was undervalued relative to United. So when it was actually defeated, the stock rallied, and the stock is up a great deal since then. So it's an unusual situation because it got blocked once and rallied, and when they lost the court case, it continued to rally. So it was one of those things where it was just so undervalued that the undervaluation provided a great deal of protection. So that's the best example of the way that we approach it. We're looking for undervaluation primarily, hoping for some sort of catalyst that may or may not occur, and then looking for other ways to sell options to sort of improve the return as you go along. Sell options where there's very little, sell puts where there's very little chance of them being struck.
Now, I work in a very different field of the financial industry, but I know maybe 5 or 10 mergers off the top of my head right now. So that makes me wonder and think about, how do you find opportunities to implement merger arb? Is there a publication that you read to find mergers that are going through, or what's your research process look like?
We have a list of all of the arbs, of all of the mergers that are going on. They're just ranked on. They're ranked on two things. They're ranked on the size of the absolute profit in it. Can you make 10%, 15%? The other possibility is the annualized profit. And then we go through them all and we look at, are they undervalued as a first sort of cut? Is this likely to go through? Are there other interesting ways of playing it in an option sense? I have to say we don't have a lot on at the moment because they all tend to be pretty tight, and there are no outstanding ideas right now.
And does it become a lot more harder to quantitatively assess these opportunities if the acquirer is paying for the new company in stock?
No, you just work out the ratio, how many shares are being offered for how many shares are being acquired, and I have a Google spreadsheet that tracks them all, so you can look at the updated price on a sort of tick by tick basis. That's how we looked at Aetna was offering. I can't remember now the exact ratio, but it was it was some fraction of an Aetna share for a Humana share.
Would it be possible to short out the exposure to the Aetna shares if you're buying Humana?
Yes, and we did that. And that was probably a bad thing to do because the everything in that sector rallied. So we would have been better just being naked long. But if the market had gone the other way, it would have had a different outcome.
That's fascinating. Let's pivot and talk about your long-short quant equity strategy. So where are you seeing opportunities today?
Well, let me pull it up. So I have a website, the Acquirers Multiple, that shows all of these opportunities in at any given time. If I go through the top 30, so there seems to be there's a lot of semiconductor equipment, electronic equipment. There's a biotechnology company in there. Let me just see. Airlines. There are 4 airlines in the top 30, 2 auto components, 2 automobile companies, 2 biotech, 4 metals and mining, 3 oil and gas, a little bit of specialty retail. Foot Locker is one of the specialty retail. That's free on the Acquirers Multiple website. You can go through and just see the sort of names that it pulls up. There's some interesting stuff in there. So United Therapeutics is an interesting company. It's a biotechnology company, but it's net cash. It's throwing off pretty good operating earnings, pretty good free cash flow yield. It's an interesting stock that I've been looking at. It's currently the second in the screen. I think it's worth sort of between where it's trading and $100. So it's trading at $109 today. It's between sort of roughly $110 and $200. That's a very wide range for evaluation, but I think the downside is very limited in something like that.
And when you're doing the security selection for this portfolio management, do you employ solely quantitative analysis, or is there Do you use the quant screen and then follow up with qualitative analysis to either juice returns or reduce risk?
Yes, but the qualitative analysis is done in a quantitative fashion. So what we're looking for is things that are in the notes that should be on the balance sheets. Some of these things are going to be fixed in the next round of changes to the accounting standards, but operating leases is an obvious one where it's just you have the choice whether you buy an asset outright and then borrow against the asset. If you do that, then the asset sits on the balance sheet and the debt sits on the balance sheet. If you lease it, then because the ownership never transfers to you, the lease obligation doesn't ever sit, the liability that the lease obligation implies doesn't sit on the balance sheet. Accounting standards are going to change that now so that lease obligation will be brought on, but previously that's something that had to be done by hand. And there are a variety of other things like that, underfunded pensions, various things that need to be manually brought onto the balance sheet. And then you also want to look at so I'm not just looking at operating income. I want to make sure that the cash flows match the operating income. And there are different ways of doing that. One is to look at the changes in the accruals on a year-to-year basis, and then to actually look at the cash flow. So you want cash flow to at least match or roughly coincide with operating income over a period of time, because if it's not, often that's a sign that there's some fraud going on. They're reporting better and better earnings, but it's not really actually being reflected in the business. So what the point of the additional stuff that is done by hand is to make sure that the financial statements match the economic reality of the company. And at the moment, there's no way to do that. Natural language computer analysis algorithms don't do it the way a human does it. So ideally, I'd do it for every single company in the entire universe and rank them all. At the moment, I don't have the capability to do that. So what we do is we take the names as they appear and we perform that analysis. Very rarely do we find something that doesn't pass that analysis. But it's always a concern if you're a quantitative investor that you've identified a company that's quantitatively cheap based on the financial statements, but the financial statements don't match the economic reality of the business. So that's the thrust of the additional work.
This idea of making adjustments to quantitative models to improve outcomes is really fascinating to me, and you've written about it in your books with respect to the broken leg phenomenon. So can you talk a bit about that and how it relates to what you do in your long-short strategy?
Right. So the broken leg idea is that it's an example of Johnny goes to the cinema on a Friday night. That you might construct an algorithm that predicts whether he goes or not, and the algorithm might include information like, is it showing an action movie which he likes? Is it a romance which he doesn't like? Is it raining, which means he's less likely to go? Is it a dry night? He is likely to go. So you might have a few of these important factors that dictate whether he goes or not. You learn one night that he has a broken leg, and that information is not in the algorithm. It has never considered that possibility before. The argument is that you should therefore be able to override the algorithm. And the argument against that is that the reason that you don't override the algorithm is that when humans exercise their discretion, they tend to do so too frequently. Everything looks like a broken leg. And it's particularly apt in deep value investing, because these are companies that are already not great companies. They all look like they have broken legs. So if you go through the list, you desperately want to override the decision in every single one of them, and you wouldn't end up with much in your portfolio at all. The way that I have avoided that is there are things that I know that aren't really important, and those are business quality. What do I think about the business? What do I think about the prospects of what this business can do? But the things that are important that I have found when we go back, so we can go back and look at every single name the portfolio would have bought all the way back to 1963, and you find that there are some sort of clusters of problems, and those problems tend to cluster around the problem that I'm trying to eliminate, which is that the financial statements don't match the economic reality.
Have you read or seen about Joel Greenblatt's research with factor-based investing and human interference with that strategy?
So he's talking. Is this the he wrote an article for Morningstar in 2011 or 12 where he said your 2 cents may cost you. I think that's the name of the article, something like that. And the idea was that he looked at his original sort of investment firm that had offered magic formula style investing was called Formula Investing, and they were going to allow people to take the magic formula names and buy a portfolio of those names, but they could cherry pick, they could put whatever names they wanted into the portfolio. At the very last moment, they offered this sort of automated feature which just said, buy them all and then rebalance, do all this stuff for me. And he found that the people who did the discretionary investing underperformed the automated system. And the problem for the discretionary investors was that they exercised their discretion to pull out all of the big winners. So as a group, I think the market did something like, over the 2 years, the market did something like 60%. The magic formula did something like 80%. The discretionary investors did 50%. So they took what was a winning strategy and underperformed not only the strategy but the market. And when he looked at the portfolios, that the discretionary portfolios that had done quite well, he found something odd in there too, and that was that the discretionary portfolios that outperformed had bought a portfolio that basically looked like the automated portfolio, and then they'd never traded again. They'd just sort of forgotten that they had these stocks there, and that had tended to outperform too. So his conclusion was that exercising your discretion leads to underperformance.
And it sounds like, just based on the anecdote that you shared earlier, that you've experienced this firsthand with your investing around the financial crisis. You said your portfolio of net nets performed really well, but when you just looked at the cohort analysis of the companies you excluded, they did about 3 times as well. So that's another example of the phenomenon.
That's right, and that's one of the reasons that I had gone through and had excluded these companies that were losing money. But when you look at the research into net investing, it's an unusual thing. And in net nets, the companies that lose money do the best. And so I had gone through and picked out all the ones that did the best, thinking that I was sort of enhancing the risk, limiting the risk in the portfolio, but it just limited the returns.
And then just to back out and speak more broadly, what's an example of an individual investment opportunity that you're very excited about right now?
I tend to not like discussing individual investment opportunities because I much rather invest at a portfolio level, and I'm always concerned that if I give one name, then people go and buy that one name, and I could roll out of that at the end of the next quarter. I could be selling that, and I don't really want to update people about that. So I think that the best way to approach the market is to have some sort of good process for identifying undervalued stocks that you can stick with through thick and thin, and that's the way to go about doing it. So I like to use the acquirer's multiple. I use that to pick longs, and I use that to find shorts as well, with the additional proviso that I just discussed earlier, that have no momentum. So if people are interested in finding stock picks, then the acquirer's multiple has a free screener on it.
One of the things that I wanted to ask you, just to wrap up our conversation, is about all the work you've done at Greenbacked, through your books, through Carbon Beach, and more recently the Acquirer's Multiple. Looking back at all of this writing and research, what do you feel has been the most rewarding or insightful for you personally?
I mean, Greenbacked has been great for me because it introduced me to Wes, which then led to the first book, led to other books, and that was a free blog that I was sort of doing in my free time while I was working in a fund in Australia. So I looked at US stocks because I knew that fund would never buy US stocks. But I had worked in the States as an attorney, and my girlfriend then, who's now my wife, who we have 3 kids together, I knew that we'd be coming back to the States eventually. So Greenbacked has been great from that perspective. It led to all of the other opportunities. And right now I'd say it's probably the acquirer's multiple. I was sitting in the finance library at my university reading through these dusty old finance periodicals from the 1980s talking about, and they were talking about private equity and leverage buyouts. And I thought, if this sounds really interesting, I think this is a really interesting way of analyzing the public stock market companies. In one of those articles, the guy described the enterprise multiple, which is enterprise value on EBITDA or operating income. He described it as the acquirer's multiple as a way of sort of describing it. And that's where I got the name from. That's why I call the site the acquirer's multiple. And that's why I call the little algorithm the acquirer's multiple. And I can't for the life of me find that periodical. I've got no idea where it is. I've gone back to that university, and there's thousands of books on shelves and shelves of books that I think I read through in the time that I was there. I wish I could find it, but if I could ever find that, I'd probably try and buy that periodical, because that little algorithm has been very good to me.
Awesome. And then just as a last question, Tobias, if people want to learn more about you and what you're doing, where can they find you?
I'm on Twitter. I'm sort of addicted to Twitter, so I'm on Twitter, and the handle is @Greenbacked. It's a funny spelling. It's GREENBACKD, like the old Ashton Kutcher punked. There's no ED there. I also have a website, Acquirers Multiple, and all of my books are on Amazon. If you go to Acquirers Multiple, you can see it has links to all the books, has the free screener, has the blog, has all the research. So that's sort of the place that I spend most of my time these days.
Thanks so much for taking some time to talk with us today, Tobias. It's been a pleasure.
Thanks, Nick. It's been so much fun. Great chat.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.